Um, Maybe we can get started. We do have quite a bit to talk about. So first off, welcome everyone. I think you all know we're here tonight to talk about on-chain bonds, and we're here with a stellar lineup of speakers to give you some insights to on-chain tokenized debt products and the private credit market in general. You'll hear from two presenters from very forward-thinking companies who have chosen this route as a financing option, and they'll tell you why a little later on. But private credit has been a trending topic, and it's grown to an estimated $1.7 trillion market, according to some reports in 2023, largely due to the macro environment, including higher interest rates. And also in emerging markets, banks currently provide 90% of the corporate funding, but a lot of the Asian banks are pulling back, reducing their appetite and offloading distressed assets. So it presents a lot of opportunities for alternative lenders. And I think similar to private equity, private credit is an interesting space for tokenization, and we can reap a lot of benefits from tokenization, just like private equity. Private credit, by its nature, it's private, so you don't have readily available data points to assess in terms of investments like you do in the public markets. But from our perspective, I think private markets in general lack accessibility. There were never the same kind of infrastructure compared to the public markets, no dedicated marketplaces to trade these products. So it became very difficult and cost prohibitive to transact in small amounts. And so fast forward to today, we now have platforms like Obligate and InvestaX with the mission to provide the necessary infrastructure to overcome some of these hurdles. So I guess before I get too carried away, let's do a round of introductions, starting with myself. My name is Alice Chen, and I am the co-founder and general counsel of InvestaX. I'm a lawyer by training, and I was with private practice firm Skadden Arps and DLA Piper in Los Angeles and Shanghai before we started InvestaX about 9 years ago. And InvestaX is a Singapore-based blockchain platform offering end-to-end services for tokenization of real-world assets, otherwise called security tokens, including the token issuance, custody, and trading of these tokenized assets. And we now offer these services in a SaaS solution. At the same time, we hold all the requisite licenses, including a capital market services license, recognized market operator license, to be able to then distribute and trade these tokens. Essentially, we've built this one-stop solution for tokenization. So anyone who owns an asset of any value, it can be intangible, tangible, can tokenize their asset and take them through the full life cycle of the token in a regulated and compliant manner. We also provide advisory services and ancillary services like banking solutions, all integrated onto one platform. Basically, allowing issuers to focus on their businesses and what they're good at without having to invest the resources to build their own tech and get their own licenses. We have done a number of world first projects, including tokenizing the Singapore Variable Capital Company in a native on-chain structure in a project called BVCC. We've tokenized our own ESOPs. We've tokenized on-chain portfolios for VCs. And one of the things that we're most proud of is creating the world's first automated market maker for real-world assets, modeled after Uniswap, but this was specifically designed for real-world assets. And this is a sister platform called IXSwap. From, I think, a platform perspective, I think as evidenced by the fact that we're collaborating with Obligate, we're all about building the RWA ecosystem and not working in silos. And we've integrated with a number of public blockchain protocols and entered into a number of partnerships with a wide range of ecosystem players, from protocol service providers to licensed platforms in other jurisdictions like Obligate, to grow the distribution channels and liquidity. But without further ado, we want to introduce Nadine from Obligate. And if you will, Nadine, maybe introduce your background, because I know you come from a very traditional finance background with very large institutions, BlackRock, UBS, Credit Suisse. How did you get into the space? Tell us more about Obligate, and how we're collaborating to bring more tokenized products to more people, and hopefully answer the question, why should we tokenize private credit?
Sure, thanks, Alice. So my name is Nadine. I'm the head of distribution and partnerships at Obligate. Obligate is connecting issuers with investors in the most efficient way through the blockchain. Use all the efficiencies and benefits blockchain is providing to the private market infrastructure here. We're accessible for qualified investors. We are regulated in Switzerland, and we also use the Swiss regulation to issue our products. I will tell more throughout the presentation about Obligate, how you can access the platform, what the products really are, and why we are doing what we're doing. But let me briefly talk about my background. So yes, I'm coming from the traditional financial world. I was working a long time for UBS in the asset servicing sector between Zurich and Singapore. So I know both jurisdictions very well. And also I was managing several projects across continental Europe, Middle East and Africa for BlackRock, mainly in the outsourcing sector. So really looking deep into the value chains of asset managers, banks, and insurance companies. And I've decided that blockchain can bring a lot of benefits to the table. So I love to combine the topics asset management, opening up markets, private markets in combination with blockchain technology. And I think especially bridging TradeFlow with DeFi is a very interesting topic, and pioneering more the investment universe, I would say. So today I'm really looking forward to bring the on-chain bond strategies closer to you and explain or navigate you a little bit through the tokenized bond universe. But before jumping in, maybe Tom and Joel, would you quickly give a brief overview before we then go deeper into Mikro Kapital and TradeFlow later in the presentation?
Okay, thank you very much indeed, Nadine. So my name's Tom James, and I'm CEO, CIO of TradeFlow Capital. Me and my co-founder, John, back in 2016, we looked at the problem of how to help enable and finance trade. So this is bulk commodities, which are the lifeblood of modern civilization, agriculture, foods, metals, stuff to build things with. And to address what's called the trade finance gap, which has evolved over the last decade or so, particularly after the global financial crisis. The cost for banks had just increased to serve smaller companies in this financing of imports and exports. Me and my team made up of quite an interesting backgrounds around trading, investment, risk management, legal stuff, shipping, technology. So a very holistic team. We looked at how digitization could address this issue, and digital and digitization is at the core of how we do things. And that sort of led us along this journey to Obligate and working with them, and now InvestaX as well.
Thank you. Joel?
Hi everyone, name is Joel. So I was born and raised in Zurich, Switzerland, and started my financial career in Switzerland back in 2005. So and moved then with that private bank that I used to work for to Hong Kong in 2012. Spent the rest of my career here in Hong Kong. Focused always on distribution and investment products. And then in 2022, came across Mikro Kapital and was very excited. I was looking for more meaning in my work and in my life, my professional life, and really was excited about what Mikro Kapital is doing and how they allocate resources and how they help people that actually do need it. That's how I got to this this opportunity and help them grow their business in Asia, in Hong Kong, and overall Asia. I'm excited to work with Obligate. I think you know, tokenization is an important part of our distribution strategy. We've successfully worked with several platforms and also with Obligate. So we're excited to be here and be able to contribute.
Thank you. Amazing. So let me take you now on the journey through the tokenized bond landscape. To set the frame, let's define what a tokenized bond really is. It's a digital representation of a traditional bond, but issued on a different infrastructure. So we use the blockchain infrastructure. The token includes the same characteristics you know from a traditional bond. So principal, interest rate, maturity date, all the information are stored in the token on chain. And a blockchain provides here an immutable, transparent, and secure record of ownership. And if we look at the whole bond market today, it's huge. Mainly publicly, there we have $133 trillion traded in government, corporate, or sovereign bonds. And this is the number from last year. So that's the biggest part we see out there. And then we have an emerging trend, which Alice was also pointing out in the beginning of the rise of private markets. So the whole private debt, private credit market, which is estimated to reach $3.5 trillion by 2028. This number comes from BlackRock. They're very active in the space and they see a clear trend and a clear demand from the investor side in the market. And there's a very interesting report as well from BCG and ADDX, which estimates the universe of tokenized bonds to reach $800 billion by 2030. I think these are very interesting numbers, and we see a clear trend on the private market side, but also on the tokenized bond side. And just to give you two landmark examples or landmark deals, already 2018, the World Bank issued Bond I, which was a bond on chain using Ethereum infrastructure, which with the amount of $80 million for sustainable development projects. So they were one of the first ones using blockchain technology for bond issuance. And we also see from the publicly traded areas, from the corporate bond side, deals. And there was one landmark deal last year in February in Germany. Siemens issued a corporate bond on chain using blockchain, the public Polygon blockchain. And they issued a one-year bond over 60 million euros. So these are showing clearly that companies looking deep into the topic for using blockchain technology for more efficiency reasons and cost reasons. And one big example why they looking into this topic is the slide. It looks very confusing in the first moment, but here on the left-hand side, you see a traditional bond issuance process. So you have more than 14 parties involved, including issuer and investor. So obviously you need the financial market infrastructure, you need a central security depository or a stock exchange to trade the bond. Then you have different agents involved for issuing, paying, security, and listing, different parties. You also need an arranger and dealer, which are most likely law firms or banks. And then you have at least 2 custodians involved from the issuer side or investor side. So this process is very complex, and especially for issuance below 100 million, this is often too expensive for the issuer, but also too much effort often for banks or traditional financial players. That's where Obligate InvestaX are coming in. We're using blockchain technology for the financial market infrastructure. This could be either a public blockchain like Polygon or Base or Ethereum, or a private blockchain. Then the whole life cycle and settlement is done in the smart contract directly on chain, as arranger and dealer you can use platforms like Obligate and InvestaX, so distribution platforms, or regulated issuance platforms like Obligate. We're regulated under the Swiss law. And then as on the custodian side, you can use your wallet infrastructure, and there are today several institutional grade custody solutions out there. So the whole setup for connecting issuer and investor could be done in a very lean way using blockchain technology. So if we look deeper into the investor and issuer sides, especially when it comes to the process, high costs are involved due to the several counterparties. We can cut out 12 intermediaries, and also for some issuers, it's very limited to get access to the capital market for their financing needs. As you saw on the first slide, there's a huge demand on the private debt, private credit side. But also, if you look on the investor side, they want to get a higher diversification rate in their portfolio. They want to get higher yields, higher returns from their investments. And for them, it's also not so easy to access the private markets today because of certain hurdles operationally, process-wise, document-wise, legal-wise. We at Obligate, we exactly connect both sides in a more efficient way. So it's a cost reduction case. It's 5 times faster using blockchain technology compared to traditional processes. And especially for issues with smaller financing demand for project or growth, it could be a very helpful solution. And also for the investors, our products have come with a yield between 8 and 50%, which is high yield, which could be very interesting, also as diversification factor in their portfolio. And we give easy access to this product, to this private market products. So in the end, through the new infrastructure, we can lean the whole process and increase efficiency massively. But how does it really work? So if we look at the issuer, they're most likely non-bank lenders, corporates, or SMEs. They come to our platform. We look into the product structuring together with them. We do the credit assessment, and we have an integrated rating for the products. So Credora, which is an S&P portfolio company, is providing us as an external party the rating to our products. We also do the collateralization and security agent work, and we have standardized legal documentation and bond documentation in place. So the whole process is very automated and standardized. The issuer also needs to run through a KYC and AML on our platform before get listed on our shelf. Similar for the investor side, investors are most qualified investors like asset managers, family office, or institutional investors. They also need to run through a KYC and AML process before getting access to our marketplace. And then they can see all the products on our shelf available for trading or investing. Then the book building process starts when both sides coming together and the primary issuance is taking place on our marketplace. When you're an investor now, you ask yourself maybe, okay, what I'm getting in the end. We are using here the Swiss DLT law. So we're issuing Swiss bonds, Schweizer Anleihen. Under this regulation, it's a traditional financial product running on a new infrastructure. And the good thing is Switzerland is very at the forefront of the regulation. And so the product is globally usable and enforceable. If we go one step deeper and, okay, we learned now there's a lot of efficiencies. I can save costs for both sides, investor and issuer. But how does it really compare to traditional markets? So here we used our two examples, TradeFlow and Mikro Kapital. Get the most recent e-notes. So the TradeFlow e-note at the moment with a BB rating and a yield of 9.3%. If you compare this note to traditional bonds, publicly traded bonds with the same rating, we got an average yield of 5.9%. So it's a 3.4 higher yield for our TradeFlow note. And similar, if you look at a Mikro Kapital, it's a B+ rating at the moment with 9.5%. And if you compare that to the traditional bond market with the same rating category, it's a spread of 3%. This spread or this higher yield is coming from, first of all, that we target issuers with smaller size, which get obviously harder refinancing at the traditional players, but also we're cutting out so many costs in the whole process that we could save between 2 up to 300 basis points per product issuance, which obviously then can be divided between issuer, investor, or even can go to the investor side. So I think this is a very good comparison to understand where the additional spread is coming from while using efficient infrastructure solutions. Yeah, and how can you access our products? So as mentioned, InvestaX is one of our distribution partners. So our products are listed there. So if you're an existing client on InvestaX, you can access the products, or if you onboard with InvestaX. The products are also listed on our marketplace. If you run through the KYC and AML onboarding on our platform, you can also directly connect your wallet infrastructure with our platform and trade the products. If you have no wallet infrastructure in place, we also have a solution with a traditional IC number. So we can set up an active managed certificate, either holding one single token or a pool of tokens. This solution is especially interesting for asset managers who are looking to diversify their strategy and also looking into a more diversified portfolio. The allocation of the underlyings can be done by the investment manager, and this can be pooled into an active managed certificate with a traditional IC number. These are the ways to access our products. And I think in the next step, it would be very interesting to have a deep dive on the two products from TradeFlow and from Mikro Kapital. So
I think first we have Tom James from TradeFlow. Tom, I think you've been digitizing the commodities industry for a while now, and your credentials really make you the go-to expert in the energy and commodities sector, with time spent at banks, consulting firms, and even U.S. Department of Defense, if I got that right. You are the co-founder and CEO of TradeFlow, and you alluded to why you started TradeFlow in your intro, but maybe tell us more about the problem and how TradeFlow addresses the problem, and then maybe give us more idea of what's actually on offer with the tokenized debt offering available on Obligate and now available on InvestaX.
That's great. Thanks, Alison. Hopefully everyone can hear me a bit better now. I had some issues there with the sound. No, we've never put ourselves forward as what's called an impact fund that specifically is out to solve problems in the world, but we are very impactful. So, we started in 2016, basically through my work with governments and companies involved in mining and energy and agricultural businesses around the world. Could see that there was a problem with even just the financing of moving bulk commodities around the world, and this is very important for global economies. And this trade finance gap that has emerged was $600 billion in 2016, and now, depending which figures you look at, it's either $2.5 trillion or even upwards of $4 trillion gap. So, we looked at it's always nice to build an investment opportunity, but also a sustainable business where there's a problem. If you can build the solution, that's also great as well. So for investors, we're able to offer them a truly asset-backed, low risk. It's over collateralized, a bit like crypto stable coins. At the moment, our US dollar fund is like 130% over collateralized. So we always have more assets on the balance sheet than investments in physical cargo. A lot of the problem with small, medium-sized firms was the principals, the people in the business, are often coming from banks, trading firms. They have a particular niche. They have a great track record, but they've just set up their own company. They're the main stakeholders. They have a certain amount of cash, but they have the expertise. And the chicken and egg situation is that banks can only help you when you have hundreds of millions of dollars turnover and X number of years track record. So we're kind of in that gap to help nurture and grow those companies and businesses in this physical commodity space. So lending money to them, they didn't sometimes have enough track record in their legal entities. So we took a much lower risk approach, which was a simple approach. And here in this slide here, it just shows, we stand in the middle between suppliers and buyers, and we own and buy the commodity. It's usually on a ship, or it's in storage at a warehouse, in bonded warehouse, before it actually gets delivered to the final end user. That's the simple thing we do. But, to do that on scale meant we had to invest millions and millions of dollars over the last 9 years now, basically to build the legal infrastructure and the technology to be able to pull huge amounts of data on hundreds of pages of information about moving these goods around the world in an instant. So, that took us 2 years, and we launched the first fund in 2018. We've done billions of dollars of transactions, thousands of trades. And the nice thing about the strategy for investors is that it gives you a massive diversification benefit. So basically, if you've already got money tied up in bonds, in equities, or real estate, or something like this, trade finance and trade as an asset class is completely diversified away from this. Even during COVID, other things shut down, but trade carried on. People still need to heat, build things, and eat, as we say. So as long as modern civilization is still around, we're good. So it's a very fundamental business of moving these core commodities around the world to users, to manufacturing, to supermarkets, to refiners and people who make products. So great diversification across many products, and certainly we're supporting SMEs all over the world. Thanks to our processes here, we've also got involved now with 18 countries in terms of moving and supplying movement of products around. We've had 0 defaults, even during COVID, no losses, and super low volatility. So we have even institutional investors who use us as a kind of fixed income alternative, although, we're not, so because we have super low volatility of returns, very predictable, and asset backed. So, it's safe. We've been able to get the investment grade rating for our debt in the TradFi market since 2021. And we got upgraded to A- by KBRA just in September last year for our sort of 2, 3, 4-year debt. And so here we're talking about, 6-month, 12-month type of short dated, much more liquid e-notes. The nice thing about the asset-backed side of things is that all the risks are insured. So we were even supporting farmers to export out of Ukraine when the war started there, fully insured against all risks, including war risks. So real world risk is covered by the cargo all risk insurance. So if the ship sinks, if it blows up, if it gets hit by a spaceship even, and yes, we did check our policy wording. When there was a Chinese satellite coming back to Earth somewhere in the Indian Ocean, we had to double check, and they actually specified it's okay if a spaceship hits you, you're fully insured. So a lot of we're covered for everything. So if the goods get damaged or delayed or it disappears, the fund is fully protected on that as well. And that's a huge market which continued to operate. All risk insurance market continued to operate during COVID. That's supported, by Lloyd's of London, and governments make sure that continues to work. Otherwise, food and other stuff doesn't move around the world. I think next slide, maybe. Thank you. So, this slide we put together here because we had, as I mentioned back in 21, we got a traditional financial rating, and we issued bonds through traditional securities markets. That was quite a process, both costly and time consuming. We have, you often will have legal advisors for everybody, issuers, ourselves, underwriters. You're going to have a paying agent that's handling the distribution of the coupons, the quarterly interest payments to people. You're going to have fiscal agents, listing agents. You're going to deal with the exchange. You've got common depository guys who want fees as well, custodian banks who hold the notes for the investors, and then you've got to distribute information to bondholders as well. So there's a lot of people involved, and that's a lot of quarterly cost and listing fee costs and maintenance. And before that, you have to then actually create the legal infrastructure for the issuance as well. And that's another 6 to 12 month process from our own experience, and legal costs as well. With Obligate on the right hand side here of the slide, what's great about Obligate is you've got the benefits of the tokenization, but also you've got the infrastructure there as well. We were only able to work with Obligate because it has the KYC AML process in place. It has the FINRA regulation. So we're able to deal with all the investors that are on the exchange. And all of the stuff on the left-hand side of the slide is in Obligate. It does that. We just pay the coupon to Obligate system. It does the distribution of the coupon directly to all the note holders through the blockchain system. And as you mentioned, Nadine, earlier, you have the digital listing regulations there for the digital assets under Swiss FINRA regulations as well, and digital and Swiss law. So everything is legally solid there as well for investors and for our funds. Lower costs as well, which is great because we started in December last year with the first issuance on Obligate. Since then, investor interest has come up, and we've even been able to bring investors onto Obligate who have come to us and said, hey, can you build us a product? So working with the Obligate team, we've also been able to build specific structured products, not just debt products, but also a structured product, which is a tracker certificate that tracks the share price of our fund as well. And from start to finish, this was kind of this wasn't months of legal discussion and structuring and term sheets and everything else. This was a matter of weeks, if not days, from having the conversation, developing the product, and then being able to actually list it on Obligate. It's fantastic that we can actually have that flexibility to deliver within a fully regulated and secure environment what investors want. Next slide, please. So what are we offering? Well, we have, because we don't lend money, lenders typically struggle to find people that fit the scope of who they need to lend money to. We are just looking at the physical commodity. We rely on the bulk physical commodity, cocoa, coffee, sugar, wheat. That's consumable and tradable and sellable all over the world. And so we look at that, the trade itself. So we have billions of dollars of trade flow actually available to us. And so we're always looking for new investors to come in, looking at new ways and new types of investment products to offer people, because we have huge amounts of asset flow available all over the world. So that's why we've been able to look at critical minerals now recently. So we're looking at a higher yield available during this month, because we have new critical minerals that go into electrical vehicles, go into the electrification of the economies. The crazy thing is that a lot of banks that do project finance are not supporting small businesses in these critical mineral supply chains, which we need if we're to actually have this energy transition to cleaner fuels and an electrified world, as it were. So there, it's actually not the the small, medium-sized traders or manufacturers is actually the suppliers that are actually short of the growth capital. And there we can help get them the money faster, so they're actually able to grow and expand their outputs. So subordinated asset-backed. So we have the portfolio of trades, a lot of diversification, probably over 300 cargoes at the moment, just on the water or in storage. Typically small transaction sizes, so we have a lot of granularity in the portfolio, good diversification there. We have the Credora rating and the implied rating here for the short-dated stuff. But like I said, we've been holding an investment grade rating since 2021 for our funds there as well. Yeah, we look forward to offering more e-notes over the rest of the year on a very regular basis, and also looking at even senior tranche as well, which we're working with the Obligate team on as well. So thank you very much.
Thank you, Tom. And maybe just some add-on where the product sits at the moment with the 9.3% for this month. So the Cayman-based TradeFlow fund with the fund manager TradeFlow Management Co. has an significant equity buffer in the fund, and there's a small debt portion, I would say, covered with the senior bond, and our product in this light purple or stronger purple in the middle is the subordinated bond with 9.3%. That's a fund structure where our product sits. As Tom was mentioning, it's a short-term opportunity, zero defaults in the fund, low volatility. All the backed transactions are insured and secured. And it's a great building block for a diversified portfolio in the end. Great. Thank you, Tom.
Thank you very much.
Yes, hello everyone. So thanks again for having the opportunity to present Mikro Kapital to you. Excited about this. Maybe we can move to the first slides, then I can give you a little introduction. So Mikro Kapital is a spin-off from EBRD, European Bank for Reconstruction and Development. And we are focusing on operating lending companies in emerging markets or frontier markets with the goal of creating social impact, meaning financial inclusion. So, we do have the goal to include people or give SMEs lending opportunities that usually are excluded from financial markets. So that means we lend where the banks don't lend. We have in our fund about 315 million euros under management, whereof 65 million is the founder's money. So that's the equity tranche of the product. And then about 250 million is investors' money. And that is invested in form of bonds. So we issue monthly bonds. We operate lending companies in 10 countries, which includes a little Italian business that's government subsidized. Then we have Moldavia, Romania, Kazakhstan, Tajikistan, Uzbekistan, Kyrgyzstan, and Armenia, where we have about roughly 2,000 employees that look at borrowers and look at the balance sheets and the assets that we lend against. We have about 171 companies, or let's say branches, where we give out these loans. I think, from the asset class, traditionally microfinance has a very low correlation to traditional markets. And that's mainly because the connection you have with the borrowers, you are giving people access to financing, SMEs access to financing that don't usually have that, meaning you lift normally a whole family or a whole village out of poverty with these investments. I think the risk management part is very important. That the country diversification is key. We have about 150,000 borrowers and have 10 countries. These are, frontier markets, so diversification is a very important means. And of course, we have that huge knowledge. We started in 2008, been operating ever since. And we have EBRD, for example, is still a core shareholder in one of our portfolio companies. that's in Tajikistan, where they also give us direct funding. The yields are relatively attractive. Of course, we have somewhere from 9.5 to 13% yield, and maturities from 1 to 4 years. Here we focus on the 1-year product. The funds that we talk about now is in operation since 2015. And yeah, in total, we've had turnover of over $1 billion in our bonds. And of course, we have a lot of high name partners. The biggest one, the most recognizable, is probably EBRD, European Bank for Reconstruction and Development. But also we do have, that's public information, Mirabaud Wealth Management that, for example, implements our bonds in their strategy. Yeah, maybe we switch to the next page. Yeah, and here, that's an important part of our strategy, is that the impacts that we create. So as I said, we have a lot of very small, 179,000 small end borrowers that we have lended to. That's always asset-backed lending, so we lend against a collateral. And then the reason is, and we also only lend to our own companies, so our own companies that we majority own. And the reason for that also is that we don't take any management fees for what we do, but we only get paid on a success basis. So we get paid based on the equity tranche return, which means if the non-performing loan rates go up in our portfolio, that's paid by the equity tranche, by us, and not by the end investor. So the investor gets their coupon before we get paid. So that's quite unique, and that's what also attracted me to join Mikro Kapital. That they put their money where their mouth is. Then yes, SDGs, that's famous impact or ESG development goals that we have. I think where you can see that very much is we have a lot of rural end borrowers. So 47% is rural area. We operate largely in Muslim countries and have a relatively high female borrower rate, considering that, of 35%. I think the sector diversification, that's also where you see that we are focused. So 60% is agriculture business, and that shows as well that we are operating very much in these rural areas where people don't have access to a banking system. I think one point that's not mentioned here that's quite important for me for the ESG component or impact component is, how do you handle delays or defaults in your portfolio? How do you work with these entrepreneurs when they run out of money, they can't pay back the loan? So I think that's a key principle where we stick to. So we are very different. We're not operating as loan sharks. When we measure the 30 days delay, 90 days delay, and then of course the defaults, after 30 days, we will start a conversation with the entrepreneur. We send one of our employees there to look at their books and see what the problem is. If they can pay up, then we continue. If they can't, if we find out that their financial situation has changed as such that they can't afford the loan anymore, then we will suggest them to sell the collateral that they gave us for the loan. Normally we give a 50% loan to value on these collaterals. We let them sell the collateral, meaning if they receive more money than this 50% lending value, then they can keep this money and use it to restructure the business or restart operations. And we waive all penalties and interest rate charges for them, so they are able to restart. So our goal is not to ruin the entrepreneur, but really to build him up and help him get back on his feet. And I think that's a big differentiating factor from traditional lenders. Normally in like these borrowers, they stay with us for a couple of cycles. If then they do very well and their business grew, then we happily pass them on to the banks for bigger financing. And sometimes they decide to stay with us for the service, and yeah, that's really up to the entrepreneur. Of course, they can stay with us as well and continue.
Great.
Yeah.
Thanks, Joel. I think here also we can offer a really interesting impact investing opportunity that supports the real economy. The product that we offer has a 9.5% yield on a 1-year maturity. It's also asset-backed and with a significant equity and cash buffer in the fund. It comes with a B+ rating, And as mentioned, well, I think you have an amazing track record of over 16 years. And yeah, the fully collateralized underlying portfolio, and also the correlation of this e-note to traditional asset classes is rather low. And yeah, I think it's also a great diversification factor in the portfolio. Yeah, this was summarizing the terms I just mentioned. And yeah, here you also can scan and come directly to the platforms to get more information about the products and the onboarding and more details. Alice?
Yeah, I think this brings us to the end of the presentations, but we will leave some time for questions. If there are any, please post them in the Q&A. And obviously, you've just seen, you know, some great companies present. These are all established companies operating for a long time with great track records, and they've all chosen e-notes because of the efficiencies provided and the cost savings and the recognition that tokenization is a tool that goes beyond fundraising alone, right? And I think the flow diagrams, which Nadine shared, as well as I think the comparison chart, which Tom presented earlier, really illustrate the value of these on-chain tokenized debt products. They're available on Obligate and InvestaX now. So this is how you can access these products. And we'll open up the floor to any questions. I am mindful of time. We've gone over a little bit, but if there are any questions, please post them there. Otherwise, you know, reach out to any one of us directly. Do we have any? Are they in the Q&A? I mean, I personally have a ton of questions, and I can probably ask them for the sake of just my own knowledge. But you know, Tom, I think in terms of you spend a lot of time. You said you spend a lot of time getting the legal and the infrastructure in place. So you know, how do you enforce defaults if there are any? And I think that this question can apply to Joel as well.
No, thanks, Alice. That's a good question. So I think this was the key thing, as certainly, you know, we're helping SMEs out, but also getting a nice, secure asset-backed return for investors. So when we looked at the issue, is we wanted to not rely, you know, on the SME's balance sheet. So we rely very much on the transaction itself. Now, a lender would have a security, a lien, some rights over the physical commodity. But if somebody defaulted and didn't pay you back, you'd have to go to court, prove that you had these rights, find the cargo, maybe it's not there anymore, chase around the world. And that would have been and was very difficult during COVID. So, you know, a lot of lenders had issues there. We didn't have issues because we don't lend money. So rather than a lien or some control over the cargo, we actually own it. So we've never had a default, but we did have some people disappear during COVID. They literally fled their country in Africa somewhere. But we owned the cargo. So what happened was, in the first instance, it was actually around the insurance, because all the cargoes are insured. And our counterparty didn't help with the right timing to get the insurance renewed. Yeah, so 30 days in advance, you've got to renew the insurance under our terms and conditions. So we contacted them, couldn't find them. So we put them on notice, cancelled our contract to sell that cargo to them, sold it immediately to another trader, actually at a profit. So the crazy thing is like during COVID, if everyone had defaulted and not taken delivery, we would have made more money for our investors. But, you know, so our default scenario is very different because we're over collateralized. So we actually own these cargoes at a discount, basically, for the ease of conversation. It means that we've got this 20-30% value buffer, which we can use to move that cargo somewhere else in the world and get a good value for that commodity. And this is these are liquid bulk commodities. They're very generic and very tradable around the world. And so that's a very quick process. We don't have to go and chase, although we have all the legal recourse and rights to chase the SME counterparty for default. We could do that, but we'd rather first just quickly get the money back to the investor. So and that's how our strategy is slightly different from the lending strategy. I hope, yeah.
Yeah, and I think clearly that's a benefit of asset-backed offerings. And Joel, maybe we pass that same question to you.
Yeah, sure. I think we have two different approaches. When we lend, if the entrepreneur has enough cash flow and the collateral, then we lend against the collateral, but also at a discount. So let's say, it's not more than 50% of the value of the collateral. Now, if they have cash flow but no collateral, then, and that happens quite frequent, then we would do a leasing contract. So meaning we buy the asset that they need for them, and they amortize it with every monthly payment, and therefore the collateral remains in our possession, if you want. So that becomes easier to enforce if there is really a default. But as I mentioned before, I think our first way to handle these situations is to help the entrepreneur to really get out of the situation. And we also, if somebody collaborates with us on these situations, then we also are willing to work with them again. So really, it's the impact side of it is very important. And we also think, that's a great character sign if somebody tries to work out of a difficult situation with us. So there's always solutions then to continue a relationship or help each other. Worst case, if really there is collateral, normally for our portfolio we have 0.8% where we really lose the investment. That's a low number, but that happens mostly because either the collateral disappears, and that has happened before, or it's a mostly more frequent case is that it's a highly depreciating asset that very quickly depreciates. And that's where then our experience comes into play. So, because we have so many different transactions, we have great data on what assets work and why not. For example, for us, we used to lend on IT equipment. We don't do that anymore because that, has the potential of depreciating so fast that, sometimes even if the borrower wants to work together, that there's no more value in the asset. That's just experience, I would say, of these different companies, what works and what doesn't.
All right. I think we'll just take these two questions, and then I think we'll have to end that. But there is a question directed directly to you, Joel, and it's a short one. Which region do you offer these loans?
So our bonds are issued out of Luxembourg, and then this entity in Luxembourg gives loans to our subsidiaries, which are in 10 different countries. So now we're speaking about, there's an Italian business that's a kind of a government subsidized business. So Italian government guarantees us 80% of the outstanding loans there. They just wanted to have a little bit of SME support. Then we have Moldavia, Romania, Kazakhstan, Tajikistan, Uzbekistan, Kyrgyzstan, and Armenia, where we operate lending companies. So we have licensed lending companies there, 2,000 staff and 171 odd offices that we operate in these countries. So that's the regional exposure.
Okay, thanks. And then I think one last question, and we have to end the session, but maybe Nadine, could you take this one? What do you think? Are there any privacy concerns of having the bond deployed on transparent blockchain infrastructure?
Not at all. As blockchain is well secured and decentralized, but also anonymous in a way. There's no privacy concerns at all. And given that on our platform, on Obligate, investors and issuers need to run through a KYC and AML process, we can also reduce or mitigate the fraud risk and give even more security to both sides through this additional checks. So I would say using the blockchain infrastructure, it's a secure, traceable, decentralized infrastructure. It's a very good option to the traditional financial way of using SWIFT or even fax. I know that some private market funds or private equity funds are still using a fax, which is, I would say, from a security level, different than the already well-established blockchain technology. So
yeah, and I would also just add that there, within public infrastructure or protocols, there is also now permission public. So only those that have been provided access and the identities and permit access can actually have those data points. So there are ways of reducing the privacy concerns. We're getting more questions. I wonder, how do you all feel? Should we just, can retail investors from anywhere in the world investor? No, unfortunately, these are all professional credit investor investors. There's now a ton of questions coming in. Nadine, I'll take your lead. Do you want to take them, or?
If we have some more time, we can take a few. Otherwise, I would encourage everyone to reach out to either Tom, Joel, Alice, or myself directly. If you have questions for InvestaX, Obligate, TradeFlow, or Mikro Kapital, please feel free to shoot an email to us and let us know directly. We're happy to take up the conversations.
Yes, thank you. Thanks for joining us again today. I've learned a lot myself.
Great. We're looking forward to all the questions and the follow-ups.
Yeah. Thank you.
Thank you, guys.
Thank you very much.
Thanks so much.